Imagine a company right at the absolute bleeding edge of healthcare, using artificial intelligence to completely reshape how we diagnose, how we treat diseases, all while growing at this just astonishing rate.
Right.
What if the visionary founder behind it all has a track record, that includes both monumental successes and some pretty controversial ventures? And what if, despite all this incredible promise, there's this consistent large scale pattern of insiders selling their stock? Today, we're going to untangle these fascinating, sometimes conflicting threads. We want to give you the full picture of Tempus AI. Welcome to the deep dive. This is where we take a whole stack of information, earnings reports, analyst notes, internal research, and we distill it right down to the absolute most important nuggets of knowledge, the insights you really need to be well informed. Today, our deep dive takes us into Tempus AI Inc. They trade on the NASDAQ ticker symbol TEM, and this analysis it's based on information current as of August 14, 2025, and we're looking at Tempus AI through the lens of value investing principles.
Right. And our mission for you, the listener, is really to explore a central critical question here. Can Tempus AI's, frankly, vast data moat and its cutting-edge AI prowess actually translate? Translate a decade of explosive growth into sustainable long-term investor value? Or does its high-flying valuation, coupled with that, well, intriguing history of insider selling, does that signal more of a cautionary tale? We'll start by breaking down their very recent Q2 2025 earnings. They were quite the surprise. And then we'll move into a structured analysis across 7 key areas. Should reveal everything you need to know.
Okay, let's set the stage then with those Q2 2025 earnings. They just dropped a few days ago, August 8th. Wall Street honestly had some pretty challenging expectations for Tempus. They were bracing for a non-GAAP loss per share somewhere in the range of, negative $0.23 to negative $0.25, with revenues projected around $297.8 million up to maybe $299.8 million.
Yeah, pretty tight range there. And Tempus AI didn't just meet those expectations, they significantly surpassed them. They reported a non-GAAP EPS loss of not ago $0.22. That was a positive surprise, over 4%. But the real head turner, that was revenue. It hit $314.6 million, which is an incredible 89.6% year-over-year increase, beat the consensus estimates by more than 5%. And following that impressive beat, management went ahead and raised their full year 2025 revenue guidance to $1.26 billion. And critically, they reaffirmed a forecast for positive adjusted EBITDA of $5 million for the whole year. The market, well, as you might expect, reacted decisively. Stocks surged over 9% pre-market. It's a pretty clear signal that investors see the company moving in the right direction.
Okay, so with those impressive earnings fresh in our minds, we have to ask, what is Tempus AI actually building? What's under the hood? Let's kick off with Chapter 1, the business of intelligent diagnostics. So at its core, what exactly does Tempus AI do? They seem to operate right at that dynamic intersection of technology and healthcare, using AI, artificial intelligence, to drive what they call precision medicine. I like to think of it, like you said, as a truly virtuous cycle.
Precisely. It really is a powerful feedback loop. So Tempus collects massive amounts of diverse data, clinical data, molecular data. Then they leverage their proprietary AI operating system to generate what they term intelligent diagnostics and, importantly, highly actionable insights. These insights, they flow back to clinicians, right, for personalized patient care, and simultaneously they go to pharmaceutical partners, helping them accelerate drug discovery development. This creates 2 distinct but very interconnected main revenue streams. First, there's genomics. That's their largest segment. It encompasses services like comprehensive genomic sequencing for oncology, hereditary cancer testing. This brought in a really robust $241.8 million in Q2 2025 alone. That's up an astonishing 115% year over year. Then you have data and services. This is their higher margin segment. Here they license de-identified datasets and provide services for clinical trials. Pulled in $72.8 million in Q2 2025. That's a solid 35.7% year-over-year increase.
And it's not just about the data itself, right? They have some genuinely fascinating products built on their Tempus platform that bring this all to life, like Tempus Lens for researchers, or their AI-enabled diagnostics like the Tempus XM liquid biopsy for cancer. Detecting cancer from just a simple blood draw. That's pretty amazing. They even have FDA-cleared software like Tempus ECG AF for identifying atrial fibrillation risk early. But one that really stands out to me is Tempus One. That's an AI-powered clinical assistant, and it integrates directly into a doctor's electronic health record system. What's the real significance of that direct integration?
Yeah, that Tempus One integration, it isn't just a convenience feature. It's really a strategic beachhead for them. By embedding directly into doctors' EHRs, Tempus captures data right at the source, which streamlines the workflow for clinicians, sure, but simultaneously feeds and expands that massive data moat they have. It's a classic land and expand play, really, especially in a highly regulated industry like healthcare. And that scale you alluded to earlier, it's truly fascinating. They're connected to about 65% of U.S. academic medical centers, 50% of oncologists. They partner with 95% of the top 20 oncology-focused pharmaceutical companies. This isn't just a big network. It's a self-reinforcing engine. Every new doctor, every new pharma partner they bring in doesn't just add a customer. They add more data, which makes the entire platform more valuable, much harder to replicate. And it cements Tempus's lead in a market where, honestly, data truly is the new oil. They have over 40 million de-identified records, 350 petabytes of data. It's huge.
Wow, 350 petabytes. Okay. So for you, the listener, why does all this matter? What's their core value proposition in the market? And how does it stack up against their rivals?
Well, it's kind of twofold. For physicians, they offer near real-time, data-driven decisions that enable truly personalized patient care. That's the promise. For pharmaceutical companies, it's access to unparalleled real-world data and powerful AI tools. Tools that can dramatically accelerate drug development and potentially slash those huge R&D costs. They operate in this rapidly expanding precision medicine market, a space projected to grow. I mean, the numbers are huge, anywhere from $207 billion to maybe $470 billion by the early 2030s, driven largely by genomics and, of course, AI adoption. However, it's also intensely competitive. They face sophisticated rivals, companies like Viva Systems, Guardant Health, and regulatory oversight from agencies like the FDA, CMS. That's certainly a material risk. You always have to watch that. But interestingly, that regulation also acts as a significant barrier to entry. Alongside, the immense data scale they've built in their already established network, makes it tough for newcomers.
Right, that regulatory hurdle can cut both ways. But here's where it gets really interesting for me. What gives them a true defensible edge? What's their moat in this competitive landscape?
Their primary strength, their real competitive moat, is that proprietary multimodal data library we talked about. Clinical data, molecular data, even imaging data, all linked, combined with genuinely advanced AI and machine learning capabilities. They're even developing large foundation models with partners like AstraZeneca. That's really cutting-edge stuff. This creates that powerful two-sided network effect we mentioned. More clinicians add more data, right? Which in turn makes the platform more valuable for the pharma companies. And then those insights from the pharma partnerships in turn improve the clinical tools, attracting even more clinicians. It's that virtuous cycle you mentioned earlier. It generates significant operating leverage because the data, once it's collected, de-identified, the marginal cost to use it again approaches zero, which allows it to be monetized repeatedly. That's a powerful economic engine if they can keep it running.
And a powerful economic engine indeed. That data-driven model sounds almost invincible, doesn't it? But as we entangle these threads, we have to look beyond just the tech. We need to dive into the human element, the leadership guiding this company, particularly its founder, and their track record. Let's move to Chapter 2, Management Evaluation. Okay, so Tempus is led by its founder and CEO, Eric Lefkofsky. He's certainly a serial entrepreneur. Now, as you probably know, his name often comes up associated with both incredible successes and some highly public controversies like Groupon. For investors looking at Tempus AI today, how do you weigh that complex track record? Is it a potential red flag or just, part of a serial entrepreneur's journey? What should you look out for?
That's a really crucial question, and honestly, it's complex. There's no easy answer. On the one hand, his career clearly shows an ability to successfully identify massive market opportunities. No doubt about that. He can raise substantial capital, and he knows how to aggressively scale businesses. Look at Echo Global Logistics, Interworkings. And the very genesis of Tempus, inspired by his wife's cancer diagnosis, that points to a compelling, very personal vision. However, critics, and rightly so, often point to Groupon. Another of his ventures had a hugely anticipated IPO, but later saw its stock completely collapse. Due to what were widely considered unsustainable business models, some accounting irregularities too. So this history, it does raise legitimate questions for long-term investors like you. Questions about a potential pattern. A pattern of generating significant hype, achieving successful IPOs, and then, at times, exiting. It absolutely necessitates critical scrutiny from anyone considering an investment. Okay, so scrutiny on the CEO's track record. Yeah. Beyond the CEO, though, what about the rest of the leadership team? And how transparent are they with the market, with you, the investor? Well, the broader board of directors includes some highly distinguished figures. That's a definite plus. People like Nobel laureate Dr. Jennifer Doudna, former FDA Commissioner Dr. Scott Gottlieb. They bring immense scientific and regulatory expertise, which is a significant strength for a company in this space. The company uses standard public communication channels, earnings calls, filings, as you'd expect. However, given those controversies surrounding Lefkowski's past and what we'll discuss later about the persistent insider selling, it becomes even more critical for you, the listener, to evaluate whether management's interests are truly, genuinely aligned with long-term public shareholders. That alignment is key.
Right, that alignment question is always hovering. So with that aggressive growth strategy, the M&A, the R&D spend, and those management insights, the big question becomes, how does it all translate onto the balance sheet? How exactly are they allocating all that capital?
Their core strategy is very clear. It's aggressive growth and intense reinvestment. Full stop. They're pouring significant capital into R&D, trying to stay ahead on the tech front. And they're pursuing a pretty robust M&A strategy too. Notable acquisitions include Ambry Genetics that significantly boosted their genomics revenue, and dissect AI for clinical trial matching, which expanded their capabilities. Now, as a growth stage company, you won't see them paying dividends or doing share buybacks. Don't expect that. Virtually all capital is being reinvested right back into the business. Critically, though, their return on invested capital, or ROIC, is currently deeply negative, ranging from like negative 13% to over negative 95%. Which sounds terrible, right? But this is typical for a company aggressively investing in its scaling phase. The hope is for future returns. But the entire investment thesis really hinges on the potential for a very high future ROIC. Once, or maybe if, their scalable high-margin data segment truly reaches sustained profitability. It absolutely underscores significant execution risk. They really have to get it right from here.
Execution risk is definitely the phrase that comes to mind. Okay, that brings us neatly to the overall financial picture. Let's dive into Chapter 3, Financial Analysis.
Yeah, Tempus AI really presents this stark contrast in its financials. It's fascinating. You've got explosive top-line growth battling against significant ongoing losses. The absolute key for investors here is discerning whether they are genuinely transitioning from a cash-burning startup into a sustainably profitable enterprise. That's the billion-dollar question, maybe $12 billion question.
Let's run through some of the key numbers then. As of Q2 2025, just to give you a clearer picture, their market capitalization sits around $12.1 billion. Trailing 12-month revenue is at $952 million. And that TTM revenue growth year over year, still nearly 60%, which is certainly impressive growth.
It is impressive growth. Now, while their operating and net margins are still deeply negative, no hiding from that, a truly significant positive trend is their gross margin expansion. It has steadily increased, from 40.6% back in 2022 up to 55.0% in 2024. And it hit an impressive 62.0% in this latest quarter, Q2 2025. This rapid expansion is a really strong indicator of the business model's inherent operating leverage. It shows that potential path toward profitability as they scale. Their net loss has also improved dramatically, narrowed to Medica $42.8 million in Q2 2025. Compare that to Medio $552.2 million in Q2 2024. Huge difference. Historically, yeah, they've burned a lot of cash, but that too is improving. Net cash used in operating activities was mega at $61.5 million for the first 6 months of 2025. That's a substantial improvement from the prior year. They haven't achieved positive free cash flow yet, though. That will be a key milestone for them and for investors watching.
Okay, improving trends but still burning cash. What about their overall financial stability, especially given their debt load?
Right. They've consistently reported net losses since 2015, which, as we noted, is fairly typical for a high-growth tech company that only recently went public. Their debt-to-equity ratio is relatively high, around 2.76. That does magnify financial risk, makes them more vulnerable. However, they have proactively managed this. They issued $750 million in convertible senior notes at a very low 0.75% interest rate, which is great in this environment. And they use that specifically to repay higher cost loans. So smart move there. Their liquidity looks sound. Current ratio is about 1.71, indicates they have a healthy buffer of short-term assets to cover immediate obligations. Now for valuation. Since they're not yet profitable on a GAAP basis, we can't use traditional price to earnings PE ratios. Doesn't work. Their price to sales ratio is around 12.3. Price to book is over 30. Both suggest a premium valuation compared to many companies. While their forward PS looking ahead is lower at 7.98, it's still a significant premium to many peers. It suggests the market is really baking in a lot of future growth and success.
Okay, high growth, improving margins, but still losses, high debt, and a premium valuation. Given all these complex financial details, what does your analysis suggest about Tempus AI's underlying worth? If we try to calculate an intrinsic value, where does that land?
Okay, using a discounted cash flow, or DCF analysis, which forecasts a company's future cash flows to estimate its worth today, the assumed growth rate is absolutely critical for a company like Tempus, massively sensitive to that. We probably start high, near their 2025 guidance of 82% growth. But then you have to taper it down, right? Maybe down to around 30% over several years, and eventually settle on a long-term terminal growth rate, maybe 2.5% to 3.0%, kind of in line with the economy. The discount rate also needs to be high here. To reflect the substantial risks involved, it's an unprofitable growth company in the volatile biotech health tech sector. So perhaps 14% to 16% discount rate, especially given their notably high stock beta of around 5.0, meaning it's way more volatile than the overall market. So based on these assumptions, an educational DCF model and iStress Educational suggests a wide but plausible intrinsic value range, somewhere between, say, $45 to $75 per share. This wide range really captures both the significant upside potential if they execute flawlessly and the considerable inherent risks if they stumble along the way. Lots of uncertainty baked in.
$45 to $75. That's quite a range, highlighting the uncertainty. Okay, it's clear there's a lot to unpack financially and a wide range of potential outcomes here. Let's shift gears now and look at how the broader market is reacting to Tempus AI's story. What's the vibe out there? This brings us to Chapter 4, Market Sentiment. So, what's Wall Street saying? What are the analysts thinking about Tempus AI right now?
Generally, sentiment is broadly positive among the analysts covering the stock. There's a consensus buy rating. The average 12-month analyst price target seems to range from about $65 up to $68, though you do see some firms that have gone as high as $75, reflecting that higher end of potential. Now, with the current price hovering near $69, this implies that analysts, on average, see it as, well, fairly valued right now. Maybe limited immediate upside from here, but certainly a floor of support based on their projections.
Interesting. And the media narrative, it seems like that really picked up steam, got more positive after those strong Q2 earnings came out.
Oh, absolutely. It has been overwhelmingly positive recently, focusing heavily on that revenue beat, naturally, also on the accelerating growth, and their clear progress toward hitting that adjusted EBITDA profitability target. That's been further bolstered by some recent FDA clearances they got and new partnerships they announced. So good news flow. However, this generally bullish tone is tempered somewhat by reports of multiple class action lawsuits that are currently being filed against the company. That definitely creates a layer of legal uncertainty for investors to consider.
Lawsuits. Okay. So positive analyst sentiment, good news flow, but legal overhang. This really sounds like a classic battleground stock. Lots of strong opinions on both sides. Are there any hard indicators, any data points that support that kind of intense tug of war between bulls and bears?
Absolutely. Yeah. One of the strongest indicators you can look at is the short interest in Tempus AI, and it is exceptionally high. Currently stands at 22.79% of the public float. That means over 23 million shares have been sold short. That's a massive percentage. It signals deeply opposing views and very strong bearish conviction from a significant part of the market. In that short position, it's been building steadily too. On the other hand, though, the stock's recent price action shows undeniable bullish momentum. It's trading well above both its 50-day and 200-day moving averages. That indicates a pretty solid uptrend currently. So this combination, very high short interest coupled with strong bullish price momentum, creates a really volatile, high-stakes environment for the stock. Could move sharply either way.
High stakes indeed. Speaking of those bulls and bears, let's dig into who exactly owns this company, who holds the stakes. Let's move on to Chapter 5, ownership structure. Let's start with the big players first, the institutional investors. Who are the heavyweights backing Tempus AI? Who's placed bets here?
Sure. Tempus AI is certainly backed by a roster of, well-regarded institutional investors. You see big names in there. Firms like Bailey Gifford, ARK Investment Management, known for betting on disruptive tech, Vanguard, SoftBank as well. Collectively, these institutions hold somewhere between 35% and 52% of the outstanding shares. It's a significant chunk. Their presence definitely offers a degree of validation for the company's underlying technology and that long-term market opportunity they're chasing.
Okay, so the big institutions are definitely in. But what about the insiders, the people who actually run the company day to day, the ones who are privy to all the internal workings? What's their position?
All right, the insiders. Well, insider ownership is exceptionally high here. Executives and directors control a really significant 41% to 48% of the company. That's a huge stake. And the founder and CEO, Eric Lefkowski, is in fact the single largest shareholder. He holds about 26% himself. Now, on the surface, this looks like really strong alignment, right? Management shareholders' interests aligned. However, and this is a big however, here's where it gets really interesting and frankly, a bit concerning for potential investors. The recent transaction history tells a strikingly different story, a very different story. There's been a consistent and substantial pattern of insider selling over the past year. Consistent and substantial. With virtually no open market purchases by insiders. None. In just the last 6 months alone, insiders engaged in 191 sales transactions and 0 buys. 0. CEO Eric Lefkowski has been the most prolific seller. He's liquidated millions of shares for proceeds estimated at over $300 million. That's a lot of selling. Other C-suite executives have also been regular sellers. Not just him. This is, you have to say, a considerable red flag. It just is. It raises a critical, nagging question for you as an investor. Why? Why would the most informed individuals, those closest to the company's daily operations, its future plans, why would they be reducing their exposure so aggressively? Especially if they truly believe the company is on the verge of this decade of transformational growth they talk about. It strongly implies they may perceive the stock's current high valuation as, well, an opportune moment to de-risk their personal holdings. Take some chips off the table.
Wow. 191 sales, 0 buys in 6 months. That's stark. So it's not just who owns it, but how concentrated that ownership is, and maybe more importantly, what they're actually doing with their shares.
That's precisely right. Ownership is highly concentrated. The top 5 shareholders, including the CEO, control about 51% of the company. Now, this level of concentration, it gives a relatively small group significant influence over strategic decisions, which can be good, right? Enables decisive planning, quick action.
Right.
But it also means that minority shareholders, like potentially you, have relatively limited power. You're really relying heavily on that small group to make decisions that are in your best long-term interests. And their selling patterns maybe raise questions about that alignment.
Definitely raises questions. That insider selling is certainly a point to ponder, maybe even worry about for any potential investor. Okay, now, as we start to wrap up our deep dive, let's take a comprehensive look at the potential challenges and headwinds ahead. What could go wrong? This is Chapter 6, Risk Assessment. Let's do a rapid-fire SWOT analysis. Strengths, weaknesses, opportunities, threats. Let's start with the strengths. What are the core positives?
Okay, strengths. Number 1 is that proprietary multimodal data library. That truly forms a strong competitive moat, hard to replicate. 2, their advanced AI and machine learning capabilities. They seem genuinely cutting edge. 3, those powerful network effects we discussed with deep integrations into both healthcare delivery and pharma R&D. And 4, those crucial strong partnerships, 95% of the top oncology pharma companies. That's a huge asset.
Okay, clear strengths. Now, the flip side, the weaknesses.
Weaknesses. Well, number 1 is their history of significant GAAP net losses and continued cash burn. Still not profitable. 2, that high debt-to-equity ratio we talked about adds financial risk. 3, a heavy operational reliance on a founder, the CEO, who has that controversial track record. That's a governance risk. And 4, a somewhat limited geographical presence currently, heavily dependent on just the U.S. market for now.
Got it. How about opportunities? Where's the potential upside, the growth avenues?
Opportunities look pretty significant.
Oh.
First, just the sheer size of the market, that massive and rapidly growing total addressable market in precision medicine overall. Second, potential expansion into new disease areas beyond just oncology. Cardiology is one they've mentioned. Third, significant international expansion possibilities. They have a new joint venture in Japan. That could be a template. And fourth, the potential commercialization of new AI algorithms as standalone, potentially high-margin software products.
Makes sense. Finally, the threats. What external factors could derail them?
Threats are real too. First, intense and well-funded competition. Lots of smart people working in this space. Second, significant regulatory and reimbursement risks. Potential changes from the FDA, inflation can definitely squeeze their margins. It increases the cost of pretty much everything, labor, specialized supplies, tech infrastructure. And that's especially tough if they have multi-year fixed reimbursement contracts with payers. Costs go up, revenue stays flat, margin squeeze. Rising interest rates are particularly sensitive for high-growth, currently unprofitable companies like Tempus. Why? Because their valuation relies so heavily on projections of future cash flows, often far out in the future. Higher rates increase the discount rate used to value those future cash flows. That puts direct downward pressure on their calculated intrinsic value. And of course, it significantly increases the cost of any future debt financing they might need to fund growth or cover losses.
Right, hits them on valuation and funding costs. And what about geopolitics? You mentioned tariffs, like the recent U.S.-imposed tariffs of 2025. How does that play in?
Well, while Tempus is primarily U.S.-based in its operations, their supply chain is global and complex, especially for specialized lab equipment and the components needed for their genomic sequencing. That supply chain could definitely be exposed to these tariffs, which would directly increase their cost of revenue and threaten that crucial gross margin expansion we highlighted as a positive trend. Plus, widespread tariffs could also disrupt the global pharmaceutical industry itself, and that's their most important customer base. So indirect impacts there too, potentially hitting demand.
Okay, a lot of interconnected risks there. We've covered a tremendous amount of ground today, really peeling back the layers on Tempus AI. It's time to bring it all together now.
Let's move to our final chapter, Chapter 7, Conclusion.
Okay, synthesizing all this. The bullish thesis, the optimistic case for Tempus AI, really rests on its dominant position. Dominant within this large and rapidly expanding precision medicine market. That market growth is a huge tailwind. They've genuinely built a formidable competitive moat with that unparalleled multimodal data library and those powerful network effects. This is now translating into accelerating revenue growth and, crucially, what looks like a clear inflection point toward profitability. We see that in the rapidly expanding gross margins and in management's own guidance for positive adjusted EBITDA this year. Led by a clearly visionary founder, they appear poised to truly capitalize on this convergence of healthcare and AI for years to come. That's the bull case. However, there's always a however, right? The bearish counterargument focuses on three key risk areas: leadership, valuation, and financial execution. First, leadership. The CEO's controversial track record with Groupon. It raises legitimate concerns. Concerns about whether he's ultimately building sustainable value for public shareholders this time, or if history might repeat itself in some way.
And this concern is profoundly amplified by that relentless, large-scale insider selling we discussed. It very strongly suggests that management themselves, the insiders, believe the stock is currently fully priced, maybe even overvalued. That's a worrying signal. Second, valuation. The company's valuation is undeniably steep, trading at a high premium to peers. That leaves very little margin of safety if their ambitious growth trajectory falters even slightly. And finally, financial execution. Despite the positive trends, the company remains unprofitable on a GAAP basis. It still burns cash, and it carries significant debt, all of which introduces substantial financial risk going forward.
Okay, bull case, bear case laid out clearly. So for you, the listener trying to weigh all this, what's the bottom line on the valuation itself? Where's the stock stand today relative to its potential intrinsic worth?
Right. Our educational discounted cash flow model, which, remember, specifically tries to account for both that high future growth potential and the significant execution risk we've discussed all through this deep dive. It estimates an intrinsic value range of $45 to $75 per share.
$45 to $75, and as of today, August 14th, 2025, where does Tempus AI's actual share price stand in relation to that range?
Well, it's $69.63 currently. Tempus AI share price resides firmly in the upper portion of our estimated intrinsic value range, towards the high end. This suggests the current market price has already factored in a substantial amount of future success. A lot of optimism is priced in, assumes almost flawless execution. So while the company's fundamentals are indeed strong and its growth prospects are certainly compelling, the stock at this level doesn't appear to offer the significant margin of safety that a prudent, value-oriented investor typically seeks. You're not getting it cheap. The shares seem to be trading much closer to a fair value, but a fair value that is highly contingent on near-flawless execution of very ambitious and, frankly, challenging business plan. Lots has to go right from here to justify this price.
Fair value, contingent on flawless execution. That sums it up well. So, as you, our listener, consider Tempus AI, maybe think about this. In a world increasingly driven by data, by artificial intelligence, the most unique and perhaps critical asset might not just be the technology itself, but maybe it's the human element, the visionaries who build these complex companies, and the very human decisions they make about their own personal stakes in the future of what they've created. That insider selling looms large.
And just a reminder, this analysis was generated by an AI system. It's purely for educational purposes and should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely. And if you found this deep dive valuable, we'd really appreciate it if you'd like and subscribe to Stock Analytics AI. Members paying just €4.99 per month get priority access to deep dives on specific tickers you request. And over the next few months, we're planning on covering all of the S&P 500 stocks, and members get exclusive priority access to these in-depth analyses as they come out. If you're just looking for a one-off deep dive on a specific stock that interests you, simply drop us a super thanks on the platform. Thanks so much for joining us on the deep dive.